So today the World Bank has launched the Economic Update Report for Uganda. And for me, the key takeaway from this report is that Uganda needs to intensify its effort in regional trade. This could be done by rationalizing tariffs and then also blocking the barriers that are at the border points. One of the key panelists here also mentioned that we also need to look at the previous markets that we have had, such as COMESA, SADC, before we even look at the bigger markets such as the African Continental Free Trade Area. We have more of this report.
Estimates that in Africa, incomes could rise by up to 450 billion US dollars, lifting 30 million people out of poverty as exports, especially intra-region, so that is within the Free Continental Trade Area, jump up by about 29% by 2035. And for Uganda in particular, exports could increase by over US dollars 2.5 billion in the same period, 2035 being that end of that period.
The near-term microeconomic outlook for Uganda, which is examined twice a year, predicts a sustained recovery that will boost real gross domestic product, that is to say the GDP growth, from 4.7% in the fiscal year of 2021-2022 to 5.5% in fiscal year of 2022-2023. A prediction that isn't significantly different from the one made in June 2022. The Ugandan economy must expand even more quickly and sustainably in order to create enough jobs for one of the world's fastest growing populations, spur income growth and pull its people out of poverty through strengthening regional and international trade relations.
There would also be benefits to be had in terms of job creation. So estimates show that roughly 600,000 Ugandans enter the job market each year. And so creating jobs is an important priority for the government. And so the AFTA could potentially, if implemented fully, provide a 1.7% increase in jobs in agriculture. Also, we'll see an increase in agro-processing as well as other services. Fossil fuels, the employment in fossil fuels will decline as there will be a reallocation of employment from that sector to agriculture.
In the same vein, the Ministry of Trade notes that despite the fact that this study has an impact on the grassroots participants in the manufacturing and textile sectors, which are expected to grow, there are still issues that the East African community is currently working on to overcome.
While import growth will likely focus on agriculture and agro-processing. This is something that we are trying our level best to change, to make sure that the manufacture, the textile and all that these industries move forward, but we still have limitations. That's why agriculture still sounds bigger and sounds higher, because agriculture, anyway, Uganda is agriculture based, almost looking at the percentages. Now Uganda's exports in manufactured goods could increase also by US dollars 1.45 billion, while exports of chemicals, rubber and plastic products could rise by US dollars 396 million. This is a good projection also. And this report also projected changes in exports and imports, which will be driven by the relative intensity of labor and the reduction in trade costs under the African Continental Free Trade Area. The report that we are going to launch today is so perfect, and it is touching the local person. It's directly touching the ground where we want our journey to go. And the report, however, cautions that non-tariff barriers continue to limit trade. It has also identified it, which is our fight now as East African community, as COMESA.
Unconventionally, one of the panelists asserts that the key to boosting the economy is translating the terms of the agreement and making them realistic, highlighting common market agreements should be a priority.
Coffee, whether it's milk, whether it's anything, you know, the whole issue is how do we use what's in the agreement practically to be able to increase our exports, our production, our industrialization. And I will come specifically to the issue you have raised. But I think we need to look at it broadly. How do we benefit from these agreements? And when I talk about these agreements, because the CFTA, for me personally, I'm not sure why we are talking so much about the CFTA, yet the CFTA is a build-up from the domestic trade, from the EAC trade, from the tripartite trade, and then to tripartite is EAC, Commerce, and SADC, because we also have that arrangement. Then we go into the CFTA. In fact, when you look at that lineup, that means we're already trading with COMESA, we have a relationship with SADC, we are just adding on CEMAC, we are just adding on ECOWAS, and that's the CFTA. So when we are looking at how to benefit from trade agreements, let us look at all those market agreements we have signed and why we are not. But if we are to export our fish to the EU market, we are exporting it and we enter the market and we remain in that market. And when you look at what's happening, the history of our trade has been rejection. You know, some products are rejected, we're imposing self-bans, and for me, I think we need to address those issues. There are issues I have talked about being on the table. The private sector and the value chain actors need to be on the table in all these negotiations.
Bank of Uganda was also tasked to respond if some of the policies, like the report underlined, they have taken to keep the economy resilient are justifiable.
Is a short-term effect on growth. We expect it to be a bigger benefit in the long run. Let us increase interest rates right now, be able to curb inflation. During the report, you notice that some other countries still under the same inflation targeting have inflation of about 40%. Okay? Uganda has had inflation go to about 10.6% for headline. So basically, I think the bank is taking the right policies. Again, it is in the short term, it is a cost to growth temporarily, so that then we can, in the long term, it will be more beneficial than letting inflation skyrocket.
Since the inaugural Uganda Economic Update urged the nation to think strategically in 2013, the government has made very little progress. Now Uganda needs to clear the impediments that have long diminished the efficacy of the current regional agreements. Trade is nonetheless hampered by the non-tax obstacles such as discriminatory technical regulations, uncoordinated sanitary and phytosanitary standards, as well as failing to adhere to administrative compliance. Ronah Nahabwe, Smart 24 TV, Business Today.